Happy Friday, everybody. This is Brian Peluso, and that's Colin Harper. And also on the phone, or on the video, I should say, we've got Michael Kutch. This is our Friday Live. Of course, every Friday at 12:30 Eastern Standard Time. We jump onto Facebook. We talk a little bit about the markets, give you a few planning ideas. Before we get into that, Colin, though, let's talk about the big news. Queen's passed away.
I thought you were going to say Thursday Night Football coming
No,
back.
that was an excellent game, though. Well, it was an excellent game for a while.
The Bills.
No, my heavens, have you not turned on the news? The Queen has passed away. We have yet to figure out how that affects our clients' portfolios. Mike, do you have any input on the passing of the Queen? Of course, we haven't had a passing of the Queen in 70 years, so is this going to affect our clients' portfolios? Your thoughts on that?
No, it's not going to have much impact.
I do have some historical context on this, however, on this point that we're talking about now. As you may or may not know by Brian's tone,
there's a good chance I don't know.
There is a direct correlation between Brian's move, Brian's overall emotional well-being and mood, and the happenings of the royal family over in England. So from an office perspective, we're definitely expecting a bear week for Brian as the media coverage continues over the monarchy. But as he said,
from a geopolitical standpoint, our relationship with the United Kingdom, England in particular, is extraordinarily important and a wonderful partnership on the world stage. But I'm just having trouble connecting with this, and so I'm not going to watch the news. I'm not going to turn on the TV for several weeks now.
That's fair.
Yeah.
And, as a general rule of thumb, we always recommend everybody when they retire, turn off the news, stop looking at your account statements, and go live life.
Yeah.
So
that was very true.
I did try to confiscate Brian's phone yesterday, but he was having none.
Well, you wouldn't have to. I turned it off. All right. So that's the big news. Yes. And more importantly, football has started. We're excited to see our Steelers play at the Bengals this weekend. Anyway, Mike, let's get into important, impactful things, if you will. Not that that's not important. I don't mean to downplay this. I really don't. But what do you got for us this week, Mike?
Yeah, would you mind hitting on the disclosures real quick before we get into it?
Well, yeah, we really should cover that. That's very important. Clearly, and nothing that we talk about is a specific recommendation for your situation, not on a sector or a category, and certainly not on an individual investment, whether that be any sort of individual investment structure. These are just ideas that we're talking about, even on the planning side. Not all ideas that we're going to talk about are immediately applicable to you or may never be applicable to you, but we want those to be out there so that you have the information to empower you, which is very important to us, in our DREAM financial planning process, which stands for Discover, Reduce Stress, Expectations, Action Steps, and Move Forward. The R, Reduce Stress, is very important for this. So the first part of that is education. So this is really very educational. We hope we give you some food for thought. But clearly you can contact us if there's any specific questions that come up. So
absolutely.
Yeah.
Thanks, Brian.
And just a quick little tidbit, kind of the topic of today after we talk about the markets a bit, and I'll introduce Mike and let him kick that off. We're going to be talking about not paying taxes on your RMDs. Hopefully you saw our spokeswoman, Oprah, earlier this week, saying you don't have to pay taxes and you don't have to pay taxes. But joking aside, we're going to cover that after Mike goes into a little bit of the market commentary.
And we tie that into an earlier social post on the International Day of Charity. Of course, for those of you that are charitably inclined, that's not one day during the year, but we were just highlighting that. That was on Monday, which was Labor Day. But we're going to expand on that a little bit. From a conceptual standpoint to some actionable steps.
Now, forewarning everybody, we're going to pull up a very busy slide that may look very, very complex, and it has to do with a lot of things Mike looks at every day and tells us how to feel about. Joking aside, these are, some resistance levels, moving averages, price to earning ratios, some fairly complex financial topics. And Mike's going to take a look at this slide with us and try to break them down a bit more simply. It's important to have context as you're trying to expand your own knowledge base as an investor. Obviously, you don't need to know this stuff, but we feel like it's important to understand a little bit about what we look at when we're making informed decisions inside of our own client portfolios. So, Mike, I will pull up this beautiful slide here for you and let you take it away, sir.
Yeah, so I have some good information to share today, or at least I think it's good information. So first, I'm going to talk about some of the short-term price action, and then get into some possible levels we could see at year end, kind of depending on the whole how the macroeconomic environment plays out. So from the most recent rally peak on the S&P 500, which you can see on this chart here, it bounced off that 200-day moving average, which is pretty much at the top there. So there's a little line that is trending down. It also coincides with where really the downward sloping trend line is. I don't have that drawn out, but it's pretty much at that same level. So from there, the market sold off aggressively until hitting key resistance level at that 3,900. So you can look where that trend kind of bounces off. And throughout this week, we've been trending higher. So I was kind of thinking, and I still think that the upside potential in the short term's limited. We got to get through some different things. I was thinking we'd probably fail at those lines that we're crossing above today, which is the 100-day moving average, which is also where the 50-day moving average is.
And Mike, just so we can follow along, what you're just talking about, that 100-day moving average, what line corresponds with that on the chart we're looking at here?
Yeah, so that is the dark blue line.
Oh, there we go. I see your pointer now.
And then, you can.
Perfect. There's that pointer I need. Yeah, there. Now I can follow along too.
Yeah, and then that green line is the 50-day. So right now we're above it. We'll have to see if we close above it. If we close on Monday above it as well, that's a good sign technically that this rally could have a little more legs. But I'm kind of still thinking we're probably more likely to drift back down to that 3,900 level, and we'll have to see if that holds. I'm getting more and more confident that we're not going to dip substantially below that level. And I think we just have, we're in a weak part of the calendar right now, September seasonally weak, like I mentioned last week. But next week we'll get another inflation reading, and I think we'll see another decent reading, meaning that I think that's going to be lower than last month. Some of the reasons why I think that: gas prices continue to trend lower. Oil is breaking down technically along with the overall commodity basket. So that definitely plays into the CPI number, specifically the headline number. And then we're starting to see some easing in other areas like used car prices and airfares. So overall, I think that could give some support to the market in the short term and take us until the next Fed meeting, which takes place on September 20th into the 21st. So, big days. Yeah. So from how I see that Fed meeting playing out, it seems more and more likely that we're going to get 75 basis point hiked in at this point, a 75 basis point increase. I'm not really sure anything Powell can say at this point to sound any more hawkish or restrictive than he's been. So I don't really see big downside risk from that Fed meeting.
Well, let's hope the Fed fares a bit better than the Rams last night and stays away from turning the ball over a bunch of times.
Yeah.
Mike, so let's dive into, and I want to talk to folks about, why we look at resistance levels and what information that helps us kind of look at. So you mentioned the 100-day, moving average. You mentioned the 100-day, the 200-day moving average. When you're looking at that, kind of
50-day in there too,
and the 50-day in there too as well. When you're looking at those, kind of what does that tell you about the direction the market's heading, and why do you employ those as a tool when you're doing, portfolio management?
Yeah. They ultimately, it's just overall levels that traders look to either sell or buy, whether something's crossing above it, that might be a positive sign. But in a sense, they may become sort of a self-fulfilling prophecy where everyone's looking for these levels, so naturally more selling or buying pressure comes in on them. So you look at the longer ones, like the 200-day moving average, that's the overall trend that we're in. It's a longer time period. It takes more time for that trend to change. So like, for example, right now it's downward sloping. It takes a lot of positive price action to get that to flatten out and start increasing. You can look at some of the shorter term ones to indicate potential trend changes. So that 50-day is going to start sloping up before the 100-day and the 200-day, and the 100-day is going to start sloping up before the 200-day. So they can be earlier indicators of a trend change, and there's different forms of moving averages. I have up right now the simple moving averages, which is just the basic average from that time period. So the 200-day is the previous 200 days of trading, just averaged out. There's certain ones that place more emphasis on the most recent prices, like the exponential moving average, for example.
No, that makes perfect sense. And just to be clear to everybody who's watching too, this is a chart of the S&P 500 we're looking at right now. If we did disclose that earlier.
And also to be clear, we don't consider ourselves traders.
No.
Of course, we would consider ourselves asset allocators, making sure that we're tying in a proper allocation for proper time frames based on goals for our individual clients. So I just want to be
clear. This is just one tool in our toolkit that, among other technical indicators, that kind of shape my overall outlook in the short term of when might be a good time to buy or when might be a good time to take some exposure off the table. So I'd like to get into kind of more of the bigger picture and what kind of could shape where we end up at year end.
I love that. Well, I'm going to get rid of this chart. I think we've spent enough time here, and I'm going to let you, unless you still need it. You good, Mike?
Oh, yeah, you can take it off.
All right, beautiful. Well, I want to see your beautiful face over there down in the sunny Sunshine State.
Yeah, so two important components that people have been paying very close attention to are the Fed and inflation. But the other main driver that's going to kind of shape where we end up at year end is where earnings estimates end up. So they've come down a little bit. But so far, a lot of people are still kind of thinking that we might see those earnings come down a little more. So for the FactSet estimates, which is an investment research provider, for 2022, they're estimating earnings are going to come in at $222 about, which signifies about an 8% earnings growth over 2021. So the more important thing is 2023, because that's going to kind of base our price to earnings forward multiple on. So right now it's right around $241, which is about another 8% increase. So a bullish scenario would be inflation starts to come down, continues to roll over, and the Fed doesn't have to go higher than 4% on the Fed funds rate. So that's the type of scenario that could realistically have a 19 times forward price to earnings multiple attached to it. Now, the flip side of that is more the bearish scenario. Inflation stays elevated. The Fed is forced to go beyond 4%. Maybe that multiple looks closer to a 16 times. So if you just take that 241 2023 year-end target at $241, we're currently about a 16.5 times multiple. Pretty fairly valued, not a bad level. So a 16 times multiple, that bearish scenario, things are starting to look a little bleaker after that. Maybe we give it a 16 times. So that downside's pretty limited, down about 3%. Things get a little more optimistic, you assign a 19 multiple. So that's closer to a 14+% upside. Now, the bearish scenario, if earnings need to come down significantly, this is kind of the camp of people like Mike Wilson from Morgan Stanley. And I'm not saying this is his earning estimate, but he's kind of close to that 200 range. So let's give it a $205 for year end. A 16 times multiple, that brings us down to that real dire bearish scenario getting below 3,300, which is significant downside from here. I don't see that as a likely scenario. 19 times, which it could get to at some point, that's not too far below the current level. So I'm going to talk a little bit about where I realistically see things coming out. And it's probably a little closer to the bullish scenario. So I think earnings need to come down a little more. So let's call it 238. That would be about a 5% earnings growth for next year. I think that could be realistic as long as we don't hit any substantial recession. So a 16 times multiple would be about 5% down. I don't think we would stay down at that level for very long. I mean, things would have to go start to be improving throughout next year. 19 times multiple, that gets us a little shy of 4,500, which is about 12% upside from here. So I think realistically an 18 times would be pretty fair. That's a little under 4,300. So the interesting thing about if we get to that level, I showed you that downward trend line before. If we hit that in the next couple months, which I think could be realistic, that would be the markets breaking through that downward sloping trend line. And many technicians would indicate that's the start of a new bullish trend. So that could have substantial legs and cause that price to earnings multiple to really expand. I'm not saying this is going to happen, but let's say that goes up to 21 times. That would get us back to a new high at 5,000. So making new all-time highs would be very, very welcome by many investors. So we'll just have to keep an eye on the economic data and see how that's going to kind of go into the overall price level multiple that we assign to the market. But we could be shaping up for a decent fourth quarter rally.
I love it. Mike,
love
thank
that too.
you for the detailed information on it. And, Mike hit on a lot of points, and it gets fairly complex quickly on the investment management side of the business. But if we look at earnings per share, it's a very simple measurement. How are corporations doing? And when corporations do well, and when those numbers kind of match up on Mike's end of it, corporations are doing well, we're not in a recession, that drives the market in a positive light. There's always geopolitical risk that drives the market as well, which we've seen a good chunk of with Russia and Ukraine this year. But for the most part, politics doesn't play a massive role in the capital markets. It's a lot more the strength and health of, specifically if we're talking about the S&P 500, U.S. companies and corporations. So
yeah, it just comes down to what companies are making, and it kind of reflects the overall economic environment. So it's just a good way doing these price to earnings multiple. It's a good way to get a ballpark of where you might end up to keep your expectations realistic. So it's probably better if we don't run up too fast and cause that multiple to get too overstretched, because then at some point it's going to have to come back down. You don't want it. You don't want the stock market growing much faster than the earnings growth rate.
That makes perfect sense. Well, and you already mentioned the big things. We've got the Fed meetings coming up to kind of keep an eye on in the next couple of weeks here. We'll definitely keep you all apprised of that situation. Moving from the investment management side of it to the planning side of it, I know for one that if I can make a choice that saves me money on taxes, I'm generally a pretty happy person. My wife's generally a pretty happy person. And, generally everybody around me is fairly happy too. So Brian, you want to dive in a little bit and talk about if you are a person who is, turning 72 this year, or you've already turned 72, you're older than 72, and you have an IRA, you are required to take a distribution known as your required minimum distribution. It's a way for Uncle Sam to take all that money that's been growing tax deferred for the majority of your life and make you pay taxes on it. But I'll let Brian talk about, if you are charitably inclined, some ways around the taxation on required minimum distributions.
Yeah, definitely. And again, thanks, Mike. It was great information. All of it very evolving, a lot of changes going on. So that's why we do this every week. A lot of things change. A lot of what we're doing through the education of the folks that we work with or that would like to work with us is helping people to take back control. Take control of the things that you can, that are knowable to you, knowable to us. Many things are not. Politics are not controllable to us. Maybe we can incrementally influence it. What the market does is not controllable to us. What the monarchy does, what Russia does, and anybody else around the world, not controllable to us. But there are certain things that we can do. We take the known factors and help you to make decisions that are best in your situation. To Colin's point, required minimum distribution. The idea here is that the government has allowed you in a traditional IRA, 401k, that type of thing. They have allowed you to put money into there and it not be taxed until a certain point in time. If you were born on June 30th of 1949 or earlier, that period of time is when you're 70 and a half. So June 30th, 1949, birth date or earlier, your required minimum distribution is when you turn 70 and a half. And what they're saying is a portion of that IRA that has been protected needs to come out each year because the government wants to get a piece of their pie. They gave you the great benefit of no taxes along the way, and now they're saying we want a little bit of that. If you're born July 1st of 1949 or later, your required minimum distribution is the age of 72. Now, there is something really interesting that's come out in the last few years, and it's called a qualified charitable distribution. And what can happen there is, instead of taking that money out of your IRA directly and getting taxed on it, you can give it directly to a charity. Now, there's a couple things about this. Number one, it's got to go directly to the charity. It can't come into your hands and then off to the charity. You can send it to them directly, and we can actually help you coordinate that. We do that for a lot of our clients. Now, why would that be? Well, interestingly enough, just about every week we have somebody come to us and say, I don't really need that RMD. It's kind of an annoyance to me. I'm just getting taxed on it. I'm going to take that out and I'm going to put it into a different account. I'm going to put it into an investment. I'm going to leave it in cash, whatever it is. So they take the tax hit, but they don't really need it right now. Well, what can you do? This qualified charitable distribution is a neat idea. If you're giving money to a charity anyway, for a lot of you that are subject to the required minimum distributions, what you're doing is you're taking money out of your IRA, it's getting taxed, and then you're sending it to a charity, which is a great idea. However, you're not getting, because of the way, and this gets a little more technical on taxes, because of the standard deduction, you're not getting a deduction. Many of you are not getting a deduction on your taxes for sending that there. So how do you do this? You send it directly from your IRA to the charity. And you can do that in portions. It doesn't have to be the whole required minimum distribution. You can just do a piece of it. So if you're giving $100 a month or $100 a week, for example, to a charity, that's $5,200 a year. Maybe of your required minimum distribution, you take $5,200 and send it directly to the charity, no tax. The rest of it that comes out, if there is more than $5,200 of your required minimum distribution, the rest of that is going to get taxed, and then you spend it as you need to. So we looked at that and said, well, on the International Day of Charity, for those of you that are charitably inclined, that's every day of the year. But to tie in the International Day of Charity, this is a way that you can help that charity that you care about, help your tax situation a little bit. And this is one of the things that we can control. We know that you're allowed to do this. We know that there is a required minimum distribution depending on your birth year or birth date, actually. This is something that we can take the knowledge that we're giving to, take control of your financial situation, and take those steps that, in a world that really so many things feel like that are out of our influence. Now, here's a little nuance on the qualified charitable distribution. They changed the rules on this a few years ago. Interestingly enough, the qualified charitable distribution is for anybody that's 70 and a half. You don't have to be 72. So what they did was they changed the RMD rules from 70 and a half to the age of 72. They might change that to a higher age, but those are proposals right now. But if you are at least 70 and a half and you're not quite 72, you can still do the charitable the qualified distribution. So they changed the RMD age from 70 and a half to 72, but they didn't change the QCD, qualified charitable distribution age. So if you're 70 and a half or older, even if you're not quite 72 and have to take the required minimum distribution, you can do these charitable contributions directly from your IRA. And then when you have to take money out, maybe it'll be a little bit lower, a little bit of less of a tax hit. So that sounds like a lot, boom, but it's actually not a ton. So if you got an IRA and you've got anxiety about when you have to take money out, maybe you don't need it in your cash flow situation, and thinking, oh my gosh, I've got no choice here. I got to take money out, increases my taxes. When I take my RMD, could increase my taxation on my Social Security, could increase your Medicare premium if you're taking a whole bunch of money out of your IRA. Talk to us ahead of time. There's actually a lot of things that we can do in preparation for you getting to that 70 and a half or that age of 70.
Well, that's the biggest thing I think we run into all the time. I think 5+ times a week, I get some sort of RMD questions because there's so much confusion around it. And when they came out with the Secure Act that bumped that age up to 72, even more confusion got introduced into the mix. So we have different age requirements of when that RMD has to come out. I would encourage you, if you're listening and you're in this boat, don't get hung up on the logistics of it and the details. Talk to somebody you trust. We'd love to chat with you about it. You can boil this down very simply. It sounds extremely complex, which it is in a sense, but we're here to help guide you through and make those decisions, much easier. The, qualified distributions to charities are a fantastic option to save a very good chunk of money. I mean, if you look at $10,000 RMD for the year and you're in, let's just call it a 20% tax bracket, you're saving $2,000 that doesn't have to go to Uncle Sam. that you can either use to increase your charitable contributions or just reduce your overall tax bill. We strongly believe in charity here at HPK, and if we can help stretch your donation dollars by not paying taxes, I think it's a fantastic fit. We often see it with folks we work with a lot of folks who are already consistently giving to their church. And just by making a switch of where those funds come from, they're able to gift a little bit more because they're not paying. So on an after-tax basis, they've got a little bit more money to send the church's way. So some food for thought for you, Mike. Certainly appreciate the wrap up. We've been keeping you very busy this year. Maybe we'll give you a week off one of these weeks.
That'd be nice.
Yeah, we'll give you a week off. Let you go enjoy the sunshine down there.
I need the VIX to come in below 20 before I do that.
Yeah, and for those of you who don't know, a VIX is a volatility measure. So the higher the VIX, the more up and downs we see in the market. So Mike likes that number to be lower. His job's a lot less stressful when it is. But hey, thank you all so much for joining us. Please, like the page. We do this every Friday at 12:30. Topics will change and will be announced the week prior. Around Wednesday, we'll kind of announce the topics for the week. If there's anything you guys would like to see or any questions you have, shoot us a comment on here. We read those. We'll comment back. We want to make this, we want to start to grow this. As you know, our studio's kind of slowly been upgrading. Brian and I are actually sitting next to each other today, which is a lot more fun than being in the same. It's a lot more fun than being in the same office, just in different rooms. Because I hear him drone on when I'm in my office.
Am I droning on?
No, never.
You're killing me.
Never. As you can tell, we love doing this. It's a lot of fun for us, and we want to make it an enjoyable experience for you guys as the audience too. We are very happy to take feedback, topic suggestions, absolutely, anything like that. Shoot our way. We would love to hear it. Until next week, go enjoy your first full week of football on Sunday. I know it's my favorite part of the year where I get to dictate what is it, 60 adult men dictate my entire emotional mindset for the next, handful of months here with football season. My wife loves it too, for the record. So let's go Steelers on Sunday, and we will see you guys next Friday. Have a very safe, wonderful, happy weekend, guys. Take care.
Maybe I'll talk to you next Friday.
Bye.